What's up guys, my name is Darren. Welcome back to yet another video. Now, mutual funds, index funds, and exchange traded funds are probably all phrases that you guys have heard about at one point or another. And I realize it's really important to understand what each type of fund is, because not only could that make investing more comfortable for you in the long term, but in the long term, you could also be putting yourself in a position to save a lot more money. So in this video, we're gonna talk about those three different types of funds, the similarities and the differences between the three, and then hopefully by the end of this video, you guys have more of an idea of which type is best for you. So the earliest history of a mutual fund goes all the way back to 1924 with the MFS's Massachusetts Investment Trust. Now, the purpose of a mutual fund was and is to take money from different investors and put it into a pool that can be invested into different types of securities, whether it's stocks, bonds, money markets like treasuries, or other types of assets. Now, at the time, that was super revolutionary. Now, when you're investing, you're typically putting all your money into one type of stock or one type of bond, which can be fairly risky. But instead, you're taking your money, you're putting it into a pool, and it's being divided amongst different types of security. So you're ultimately diversifying your portfolio, which is automatically decreasing your risk of losses over the long term. Another thing that was really beneficial about mutual funds is that they were actively managed. The other purpose of a mutual fund was to not only have your money be divided into different securities, but in comparison to the stock market, its goal was to beat the annual returns that the stock market normally would reach. That kind of explains the flexibility that mutual funds had as far as how they handled your money. Aside from buying or selling those securities, they could also do shorts on certain stocks or other companies, or they could do options on other companies just as a way to make extra money in a short period of time. But because mutual funds have the ultimate goal of beating the annual returns in the stock market, they have to be actively managed. And because of that high active management, the investors themselves are going to have to pay high fees, primarily in the form of something called an expense ratio. An expense ratio is basically just defined as a type of fee that's charged by mutual funds or of the like for the management style that they have. In this case, it being active, that fee is going to be really high. The range of those fees is normally between 1% to 3%, and that percentage is based on the amount of money you invest into that mutual fund on an annual basis. For example, let's say you invest into a mutual fund like that Massachusetts Investment Trust mutual fund, and you put $10,000 into it for the whole year, and their expense ratio is at about 1%. That means every year you have that $10,000 in that mutual fund, you are being charged $100 every single year, which doesn't sound like a lot. However, the concern now is you have to make sure that not only does your mutual fund or the amount of money you put into those securities and bonds and other things of that nature, not only does that beat the stock market, but it has to actually beat the stock market by at least $100, so your returns are at least paying off that expenses. So imagine you're in a position to where you don't beat it, then you're losing money every single year while the mutual fund company is gaining money, and you're increasing your chances by, at the end of the day, when you finally decide to pull your money back out, you could potentially be pulling out less than when you initially put it in the first place. And because of that major concern of the high fees and expense ratios, that's where we get a little more comfortable with the index fund. So back in New Year's Eve of 1975, a company called Vanguard actually created the first index fund called the First Index Investment Trust. I believe it's actually called now the Vanguard 500 Index. And it's very similar to a mutual fund along the lines that it's an automatic diversified portfolio that takes your money and divides it into different types of assets. However, the biggest difference between a mutual fund and an index fund has everything to do with why an index fund is called an index fund. This may get a little repetitive, but an index fund is called what it is because it tracks an index. And an index is basically a hypothetical portfolio that tracks specific securities within the financial market or the stock market. For example, let's say that you have a list of every single stock that's available in the stock market right now, and you take the top 500 largest traded stocks from that list. You just created an index defined by the top 500 largest traded companies in the stock market. Fun fact, that's already an index fund. It's called the Standard & Poor or the S&P 500. But anyway, because it's tracking a particular index or a hypothetical portfolio of different stocks within the stock market, its goal automatically goes from beating the stock market to just having the same returns at the minimum as the stock market, since it's tracking the stock market, or at least a piece of it itself. And because it's not trying to beat the stock market anymore with different types of transactions, it doesn't have to be actively managed. It goes from being active to passive. And because it's passively managed in comparison to a mutual fund, its expense ratios that investors are charged are significantly less. Significantly as far as the percentage goes, from a 1 to 3% range to maybe a 0.05 or even less to a 0.75 or less than 1% expense ratio. So aside from the diversified portfolio that an index fund automatically provides for you, investing into an index fund over a mutual fund will automatically be less risky because it's not trying to beat the market anymore, but it will also save you more money because the expense ratios are less because it's a passively managed portfolio rather than an actively managed portfolio. But similar to there being one big thing that makes index funds a great option, there is one big thing that can make index funds a concerning option for most of you guys out there. And that has everything to do with how often you can trade an index fund. So unlike a regular stock, an index fund can only be traded one time per day, and that's at the end of the day after trading hours at that exact price. And for you guys out there, that can be good news or bad news. It just depends on your investing style. But if you're more on the lines of you want to be able to have the benefits of a diversified and low expense paid portfolio like an index fund, but you want to be able to trade it like a regular stock, then that's where you will be interested in something called an exchange traded fund or an ETF. So exchange traded funds, they started in the 1990s, and the primary goal of it was to give investors more access to index funds. Because around that time, index funds weren't as easily able to be accessed, and mutual funds were even harder to be accessed, especially because you need a lot of money for it. And over time, ETFs gained a lot of popularity. I think at this point, there's over 7,000 ETFs in the stock market right now. Now, it's very similar to an index fund along the lines of, again, that automatic diversity with your money being split into different stocks, and the fact that your expense ratio is going to be a lot less in comparison to a mutual fund because it is more passively managed and not actively. But the one big difference that separates an ETF and an index fund is how often you can trade it. An ETF is just like an index fund, except that you can trade an ETF just like a regular stock. You can buy it multiple times throughout the day until you hit your day trading limit, which means you can also sell until you hit that limit. You can buy options on ETF if you would like. You can short an ETF for whatever reason if you want to. It follows the same requirements as a stock while having the same benefits as an index fund. Earlier, I mentioned that one example of an index is the S&P 500, or real life index fund. So let's say you take that S&P 500, which is the top 500 largest traded companies in the US stock market. And from that, you take out the top 75 highest dividend yielding stocks, meaning the top 75 stocks that pay the highest dividend quarterly or monthly or basically every single year. Then from that list, you drop it down even more to about the top 50 lowest volatile stocks. And from that point, you have 50 stocks that are going to pay you a lot in dividends, but aren't going to be as super volatile. That is actually an ETF called SPHD. And that is an example of an ETF that tracks a particular index fund. Pretty much every ETF is going to track a certain type of index fund, whether it's exact or some type of modification. So with an ETF, it's great because it has the same exact benefits as an index fund does, on top of the fact that you can trade it just as a regular stock if you choose to. But at the same time, the ability to be able to access an ETF just like a stock could be a negative or something that investors like yourself out there may not prefer as much in relation to an index fund. Between a mutual fund, an index fund, and an ETF, the only confident answer I can give you guys along the lines of which one is best for you is that hopefully it's not a mutual fund. And the biggest reason that it should be a mutual fund is because of its expense ratio. Unless you enjoy paying at least $100 a month just for having your money actively managed in the attempt to beat the stock market, you may not want to go for something like that. So that would narrow it down to an index fund and an ETF. With an index fund, you have more of a passive style of investing because you can only invest into it once at the end of the trading window. But at the same time, investing into an index fund could avoid you from selling it at a point where the index fund price goes really low, or selling it when it goes really high and you want to take a profit. Then you have an ETF, which gives you the ability to buy, sell, and trade it overall just like a regular stock, which is beneficial because you have more flexibility, but in a psychological level, it could be detrimental because it could actually persuade you to access it more and do more things to it, when in fact you should have just held in the long term. So between those two, that's just something you guys want to think about. But definitely not a mutual fund. But if that's something you actually like and there's something I'm missing, please leave a comment below and let me know. But definitely leave a comment below and let me know which type of fund you prefer between index and exchange traded fund. Personally, I lean more towards an exchange traded fund. I like the flexibility, even though I typically don't access it that much. I invest more and just hold on to it. And I like getting paid dividends. Not saying index funds don't pay it, but I know ETFs pay it because I invest into them. But let me know what you guys think about those overall. And if ETFs are something that you are actually interested in, definitely check out this video that's going to give you 5 of my favorite ETFs I feel like all beginners should invest into. It gives you a reason why I think ETFs are some of the best options for beginner investors out there. I appreciate you guys watching as always, and until next time, take care.